Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture with me, Ryan Huang. As volatility roils the financial markets, investors may be eyeing risk assets with some unease. But here's an interesting take. High-yield bonds, which some might deem more risky, may actually be an attractive choice for investors looking to rebalance their portfolios. In fact, it can serve as a good option to replace stocks in the portfolio, similar returns, but lower the risk. How does it all play out? Let's check in now. Will Smith. He is the Director of U.S. High Yield Credit for AB. Good morning, Will. How are you doing today?
Good morning, Ryan. I'm doing great. How about yourself?
Yeah, it's great to have you on because you track this space very closely and you've got an interesting idea how high-yield bonds may actually be a good alternative to stocks. How does that idea play out? Why is it a good alternative?
Thanks, Ryan. Yes, we think high yield deserves a nice allocation in investor portfolios for a very simple reason. And that reason is that yields in high yield today are elevated versus history, meaning you can earn near 8% yields, which tend to be a great predictor of what you will earn over a multi-year period. And we think that stacks up really well versus equities. And traditionally, equities will give you slightly more in returns. However, they have a lot more volatility and they tend to draw down significantly more than high-yield bonds. So for investors who are concerned about volatility ahead, we think high yield is a great alternative to stocks.
All right, give us a sense of where things have been in the past few quarters. This quarter versus the last year, how have things changed for bonds?
Yields are higher, spreads are wider, as markets have certainly started to price in some uncertainty around the tariff risk. Now, we've also started to see some companies that have run into some issues. Now, that's true for both stocks and bonds, but the high yield market tends to be more focused just on U.S. production and U.S. consumers. So overall, we view the market as less impacted directly by tariffs, certainly less so than broad indices like the S&P 500.
All right, high yield, less volatility, but similar returns. So in that case, you get the same returns for lower the risk. That is the idea here. Taking a look at where bonds are, what they're pricing in. What are you seeing when they are pricing in terms of where the U.S. economy is going? What are the odds right now of a severe slowdown in the coming year?
They're not all that high now. We've seen a pretty aggressive repricing in risk assets, and high yield is no different than that. The market at the peak of the tariff fears around Liberation Day was pricing in something like a 30 to 40% chance of a recession. And that's certainly pretty high by historic standards, especially when you compare it to the starting point of the economy. As we know, the economy has been performing extremely well. And for the most part of the last several years, we've been more concerned about price stability and inflation rather than growth. So the market has started to really get ahead of itself in terms of pricing in an immediate recession. And there's been a big snapback, as we mentioned. We think that recession risk now being priced in is more like 15 to 20%, which is more, we think, commensurate with the levels of risk out there and also the potential default cycle in high yield, which we continue to think will be benign.
Yeah, in the latest earnings season, we have been hearing about companies cutting back, withdrawing their guidance. The latest is Walmart saying they might hike prices later this month because of the tariff impact. We've seen many tech companies also going through another round of layoffs. What do you make of it? Is the worst over in that sense, or is there more to come in terms of pain?
We still just really don't know what the final impact will be on tariffs. I mean, at a very high level, tariffs certainly slow the economy down, and they also put upward pressure on prices. It's all happened extremely quickly, and if you look at companies like Walmart, they've essentially been holding off on raising prices on the consumer, but they're eventually going to have to start to pass that inflation through. The big question mark, and this really matters for the Federal Reserve, is will those prices be a one-time increase that consumers just see as a one-off event, or will that start to force folks to think that prices are going to go up for a long period of time. That's really the focus on inflation expectations, which so far have held in well, meaning they are at a very reasonable levels, and that should allow the Fed to cut rates if and when growth slows in the second half of this year. But again, it's still early. We haven't seen those price increases come through on the shelves for American consumers, so we're kind of in this wait-and-see mode.
All right, we'll see if that's going to be as transitory as what Fed Chair Jerome Powell might believe. All right, taking a look at the portfolio, typically we talk about a 60-40 allocation between stocks and bonds. How do you see it, especially when you talk about how high yield has a better place in it versus stocks? And where do you pick your fixed income assets in terms of durations and geographic markets?
Yeah, so we would say that investors should consider high yield as an alternative to the stock part of that 60-40. So trimming, say, 20 or so % out of equities into high yield bonds really does not hurt your returns much at all, but it significantly reduces your downside risk and that drawdown experience should we run into some market volatility. And that's the right way to think about high yield as an allocation. It really doesn't behave like a treasury bond. It behaves more like a stock, but we think with a better upside versus downside type prospect. Now, in terms of your treasury exposure, we prefer to be in the belly of the curve, call that the 3 to 5 year part for a few reasons. One is that part of the curve stands to benefit the most once the Fed starts to cut rates. And we do think the Fed will be able to cut rates in the second half of this year. So you could see very nice returns in that part of the curve. Now, the longer part of the treasury curve, so 20 plus years, that to us is a more precarious investment. And that's really because of two reasons. One is we have not really seen that inflation expectation play out yet. There's still a lot of questions as to what the long-term rate of inflation will be, and that will impact the 30-year bond much more than the belly of the curve. So that's one big risk around the long end. The second big risk is around debt sustainability and the fiscal budget situation in the U.S., which is also a big open question. We really have not solved that issue at all. And the 30-year note will be a lot more sensitive to that sort of budget negotiation.
Yeah, a great overview of where things are in these uncertain times and helping us to figure out how to seek efficient income in the current environment is Will Smith. He is the Director of U.S. High Yield Credit for AllianceBernstein. Will, thanks for your time and insights this morning. It's been great chatting with you.
Likewise. Thanks so much for having me, Ryan.
All right, catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.